Now that you understand some of the lesser known features and benefits of this type of properly designed permanent life insurance product, let's look at it specifically through the lens of tax planning. And we're going to use an example using the same brackets we looked at. Same married couple, they're going to try and compress their reportable taxable income to a level that they can live off of and they can manage. And using some of the other strategies mentioned previously in the course, they'll still have cash flow that gets them up to those higher levels, but avoid the tax in those higher brackets. And they can use this tax savings to start to acquire this type of permanent life insurance so that they can more efficiently distribute their wealth in retirement. I think that another advantage that is worth mentioning that life insurance has over Roth accounts during your working years is the liquidity use and control. So unlike a Roth account where you can't touch it before age 59 and a half, with life insurance, you actually can. And a lot of people think, well, if I put money in life insurance, I can't do X, with X being, say, expanding your business or investing in real estate or any other wealth building opportunity that comes your way. And that's not true, actually. So you do have access to your equity, and there is no age 59 and a half limitation. So you can go ahead and use the equity inside your policy to parlay your wealth building opportunities during your working years. And you can do so in a way that doesn't kill the goose that will someday lay the golden eggs of tax-exempt retirement income. Once they hit retirement, now the fruits of their labor are going to come back and bite them to a degree. So already Social Security is mostly taxable for anybody who's remotely successful. Rents will be kicking off of rental properties. Retirement plans, you'll be forced to take required minimum distributions. All your brokerage accounts, checking accounts, CDs will all be taxable regardless of the rate. And even if you did set up some charitable split interest programs, all the distributions are taxable. You just get to choose how they're taxed by what assets you put in there. And again, there is no special tax bracket for retirees. So as this income gets distributed to you from these various taxable sources, it is going to push you into a higher and higher bracket, along with whatever tax rate that comes with at that time in the future. And nobody knows exactly what that will be, but I think we can all agree upon the fact that our government spending has increased exponentially. And even if future politicians do indeed curtail the spending, a lot of the damage has already been done. So there's programs, there's liabilities, there's obligations that need to be funded, and that's going to come from our tax dollars. So the more affluent and successful you are, the more wealth you've accumulated inside vehicles that are going to get taxed in the future, the more concerned you need to be about this phenomenon. Having the mechanism to be able to cut off your income at the pass is going to be absolutely critical regardless of the vehicle you choose. So I strongly suggest you start to think about using some of your tax savings today to plant the seeds so that you actually have the tax exempt dollars inside your retirement planning model.